Welcome, everyone, to a new episode of Trade with Conviction. I'm Felipe Sherman. I'm joined today by Neil and Phil. Hey, guys. Good morning. How are you?
Hello. All good.
Since our emergency podcast on when was it? Tuesday, yeah, I think, yeah. And yeah, crazy 48 hours since the last time we were here. To be very honest, it's very hard to hold any kind of position right now. It was already hard last week, but this week it's getting even more complicated. We talked about this price suppression or all of the announcement that Trump is continuously doing to indicate that the war is over, that they're having very impactful negotiations, that progress is being made. At the same time, obviously, he continues the threats and Israel continues the bombing as well as Iran. And I guess the ticking clock runs out on Friday or Saturday. I don't really know exactly, but perhaps these hostilities escalate deliberately during the weekend. That's generally called like a strategy where you are on the one side, the carrot and the stick. You're trying to find a negotiation, but if they don't comply, then you continue with the bombs. At the same time, they're gaining time. We understand that there's more troops heading that way from the U.S. Again, it's in these circumstances, all the evidence that we have points to a higher price. I wouldn't be surprised that it re-escalates over the weekend. So common sense would say, this is the kind of positioning you want to have, more long than short. But then again, everyone got a lot of scars on Monday. When you have a $17 per barrel drop within 15 minutes, that granted, it went up again very quickly, but still, it is something that keeps traders up at night because you just don't know when is the next time that it's going to happen. And particularly if you add these sort of suspicious trades happening 5 minutes before and things like that, it just gets everyone extremely nervous. And it's, as I said before, it's a very difficult situation to hold particularly big positions in this market. So let's see. But our job is to report what's happening or what we see. Obviously, we have the benefit of not having a position ourselves, so it's easier to sleep at night. But that's the whole point, is that we can give an unbiased kind of opinion, and we're not married to any kind of positions. What right now, all of the evidence points to, a continuous escalation, or at least not any kind of de-escalation. Neil, anything to add there?
No, that's totally fair. I mean, everybody's got their own opinions on what Trump and Iran are doing, right? So, of course, we are married to a certain way of thinking there. I'm more on the price suppression side. I think probably the consensus is that that's what's happening, but there's still a group of people out there who believe that the back channel process is going to succeed. And I don't say that that is wrong, but I just don't believe it at this point in time.
I think something we've learned also over the last few weeks, months, but also years of military history is that these kind of larger deployments very rarely don't end up actually being utilized, right? It's very rare that you see deployments of that type moving a lot of resource into a region for that to then actually fade and not be utilized.
Yeah. In the meantime, Iran's parliament is reportedly trying to draft a bill to impose fees on transit. Actually, this has already been happening on a more ad hoc basis. I think we've heard like $2 million in order to transit. But again, when the statement yesterday was that in order for any kind of ceasefire to happen, then they want to have control of Hormuz officially. So it's think about this as a sort of Suez Canal or Panama Canal, where you will need to pay a fee, and for the U.S. to repay all of the damages that Iran. It has happened in the past, and you think about the First World War. Germany had to pay all of the damages. It's not uncommon. But what's interesting is that, okay, what are the rules of engagement if they do have full control of Hormuz? What will be the cost? Will it be some sort of guaranteed cost? Who will benefit from it? Will there be some sort of back channels where some people will have to pay, others not? Well, I'm Spanish. Yesterday were reports that because the Spanish PM was essentially saying that they were against the war, then Iran said, okay, all the Spanish vessels are allowed to transit. Now, that's interesting to say because we probably don't have any vessels. But you see what I mean? This is just, if this is
get
were
a
to
lot more very
happen,
quickly if that really was true.
exactly, suddenly everyone will want to have Spanish vessels. No, but what's going to happen here? I understand the logic. I fully understand the logic. You want to repay all of the damages, and this is the best way to do that. But of course, it's pretty unsustainable when you have the controlling party that is completely unreliable. So that it's going to be an interesting one to watch out. And I say that because if when you think about the political consequences for Trump, at some point he's going to have to give something. So is that something? Let's see. In the meantime, Neil, what's going on outside of the AG? Because there's also other events.
Yeah, there's big stuff happening outside of the Middle East. Normally, it'd be very market moving. So Ukraine is, well, the background, I suppose, is that Europe and Ukraine are getting worried about Russian oil revenues, right? So Ukraine has been hitting the Russian ports of Primorsk and Ust-Luga this week. I think there was 2 separate groups of attacks. The news is that loading is at least impeded or potentially stopped from both of those ports. Phil, you can talk about the NAFTA side of things when you get to light distillates. Generally speaking, that's big news. The sort of total liquids that normally gets exported out of those 2 ports is 2.5 million barrels per day. So we're talking about something that would be massively market moving normally. Yesterday, prices barely reacted to it. I don't know Brent's looking pretty bullish this morning. I don't know if it's reacting to Primorsk or generally more missiles firing off in the Middle East. But generally, it would be a very, very interesting situation normally. The other thing is that a Turkish tanker was attacked in the Straits of Bosphorus last night. It was carrying 1 million barrels of Urals. So it looks like Russian flows out of these ports are really in danger. And that obviously should exacerbate the problem that we already have in quite a big way. If you think that Yanbu is incrementally loading, let's say, 4 million barrels per day, then this attack would be, slashing more than half of that incremental volume. It's very, very interesting. I don't know how extensive the damage is, but it is big news.
It is big news. It is big news. And it's one of those situations where, we go back to what we were talking about, many months ago, where the rule of law, international rule of law, the UN and all these things are now broken and everyone is on their own. Everyone can decide whatever they want, regionally. And, if you take that to the extreme, this is what's happening right now, where a year ago, 2 years ago, 10 years ago, it would have been unthinkable of attacking infrastructure assets that would have an impact, economic impact locally and globally. But now it's just happening more and more. And, you open that door, which is who is to say that this not continue to happen somewhere else? You see?
Yeah, and it's been happening at CPC already, prior to basically at the same time as the Iran conflict started, CPC was having difficulties. And the background is, of course, Russian or sanctions on floating Russian barrels have been lifted. India has taken about 60 million barrels for April of Russian, and they're going at like Brent +5, 10, 15. So remember, before the war, they were selling it like -20, -25 at discounts. And so that plus the flat price, the Russian revenues are going through the roof. Plus the Indians took Venezuelan, plus they're taking Iranian. It's just not a good outcome, let's say, for Ukraine, generally speaking.
Definitely not. And so, Phil, can you paint us a picture of what are we seeing on prices right now? Let's start generally, and then we can go product by product.
Sure. So a lot of the early movement through March has been to see east-west spreads really widening out significantly, and a lot of those are coming very hard over the last day or 2. It's slightly difficult, I suppose, to justify from a fundamentals perspective, so far at least, what we expect from where we are going to have crude runs at their normal levels versus in the West versus depressed crude throughput in the East, and therefore needing to move those products from West to East. As far as we can tell, it seems as though it's maybe linked to a broader kind of risk-off sentiment in the market, which, as we've just discussed, maybe justified, maybe not. If we look at kind of product by product, though, cracks have come off across clean products quite strongly. Well, both diesel and therefore jet, and therefore also gasoline as well. We'll talk about that in more detail. Something like an EBOB crack at the moment is, an April EBOB crack is at $18. An April Singapore Sing 92 crack is at $20, and it was at the beginning of this week that was +32, +33. We've had a real huge sell-off actually on a lot of the clean product cracks at a time when the expectation was that we would need margins to be very high to ensure that we got throughput at refineries that could run them. I think elsewhere, it still seems to remain true that the US Gulf Coast is largely the kind of marginal supplier, both on crude and on products. And as such, 14 and TD25 have been able to price essentially where they want to. I think world scale 500, world scale 600 seen on both of those. These are levels which even just last week would have been unthinkable, but because of how the underlying paper pricing has reacted, are actually keeping WTI is, regardless of that, looking attractive into Northwest Europe, and it's looking attractive, for example, into the East. And we've seen that typically WTI would obviously move on a VLCC into Asia, but because of the very strong backwardation and the need to get those barrels there very quickly, we've seen Afras or even just partially laden Suezmaxes trying to move through the Panama Canal into Asia to shorten that journey time. So the impact of that, if we're just looking at kind of Gulf Coast Aframax vessels or supply lists, right? That supply list has tightened very significantly. The last we've seen is that there are only 4 ships open in the 14-day window ahead, and so essentially those Aframaxes that are available in the Gulf Coast are able to name their price at the moment.
I heard as well that it makes much more economical sense to, if you have an LR2, to convert that into dirty. So that would be the next step, I would imagine, if it's not already happening.
Yes, and that's just going to make, it makes the move that we've seen in the East-West coming off even less logical or even less kind of in line with what we would expect, because if you're taking LR2s out of the Atlantic Basin market and potentially dirtying them up, those are typically the vessels that we would have been seeing going into moving naphtha, moving gasoline from west to east. Instead, actually, we've started to see some of those, for example, gasoline loading out of ARA, which we would typically see on LRs moving east. We've started to see interest in trying to pick up MRs because TC2 is one of the markets which hasn't quite followed the rest of them, rest higher. And so it seems that there's still some availability of MRs and trying to make even those kind of smaller vessel sizes work to move clean products west to east.
I agree with you that sort of sell-off is, if it's a risk associated or risk off kind of environment, makes sense. But again, just looking at the fundamentals, the physical and all that, it doesn't. And maybe an opportunity to buy here, the risk appetite.
So again, I mean, obviously we're getting close to April now, but if we're looking at an April East-West gasoline, for example, at the beginning of this week, that was trading at around +9. And as I'm looking at the screen now, it's at +180. So even at these levels, we are still seeing that Europe is the cheapest source of supply into East Africa, into Pakistan, into the Red Sea, for example. So maybe you could argue that +9 was just not sustainable, but we certainly are not now seeing ARBs open into the pricing center in the way that we were at +9. So there's a balance somewhere to be found there. +9, obviously we were opening up LRs from ARA into Singapore, and we saw 2 vessels fixed to make that journey. At +180, we are still able to pull barrels out of the Atlantic Basin and move them east for now, at least until freight rises to shut that off again. And we would expect further upsides on Atlantic Basin freight, as we've started to see from the Gulf Coast, but also now likely from Europe.
So that's an interesting one. So you're saying, if you think about this between the physical relationship and the paper relationship, ultimately the problem that you're trying to solve is that you do not have gasoline in Asia, and you do have it in Europe or in the Atlantic Basin. That paper market went to certain, and the shortage is not necessarily in Singapore. It's much more around the final destinations, Australia and maybe Indonesia, Pakistan, and all these importing countries. So the fact that the paper market went to a certain extreme, then it got corrected by the physical market, saying, well, actually, you don't really need that much the short. What the ones that need the product, the ones that need the product are all these other countries, which is now where the market has re-stabilized, so that the ARBs are open to supply those countries, but not necessarily open to put a ceiling to any kind of paper position or speculative position.
Yeah, but the impact that it's having on Atlantic Basin gasoline prices is quite complex, it seems, so far. Certainly with the way that components have reacted and the way that gas NAP has now reacted, maybe we talk about the strength in naphtha coming at least partly or maybe even largely from the news that Neil told us about Ust-Luga and Primorsk not being able to load properly. But gas NAP in Europe has narrowed very, very significantly. that's now at around, for April, it's at around $90 a ton. And that is raising blend costs for any barrels to be, any gasoline barrels to be blended in ARA. And we're seeing deeply negative blend margins on E5 and E10. But we are still seeing workable ARBs, even at these levels, out of ARA into, as we said, into East Africa, into destinations that would typically have been pulling from the AG at least. So add on to that we are seeing reports that inventories are actually draining quite quickly out of, in Northwest Europe now, gasoline inventories. I think at least it seems as though, and maybe I'm missing something, but it seems as though the paper market is really underestimating the impact that this is going to have on actual availability of barrels for the Atlantic Basin as a whole come later on in Q2 when our seasonal demand starts to rise as well. We mentioned that...
No, it makes sense. I mean, when I was looking at the tool, basically Europe is essentially the single supplier to all of what normally, would have been the shorts for the AG. So East Africa, Pakistan, South Africa, even Yambu, normally you would have Yambu importing from the AG and things like that. So that's now should be supplied by Europe. And that means that Gulf Coast is now the sole supplier, almost except for West Africa, for the rest of the Atlantic Basin. So that sort of shift west to east is there. It's obvious. It can be seen.
Mm-hmm.
Now, as you said, if this continues, and it seems like it will continue, then I was looking at the spreads, like the August, September, October spreads. Obviously, they are much higher than the last 2 years, etc. But when you compare this to a sort of like Russia kind of situation, which the fundamentals are not the same, but the extreme can be comparable. We're definitely not at the highs of that period. So similarly with cracks, it's a difficult trade because all of these different elements, crude, gas, naphtha, all of them are fighting, if you want. So you will have choppiness from time to time. Crude will rally. And then the next one is gasoline will rally. And then you have a Primorsk kind of situation and naphtha will rally. Overall, fundamentally speaking, those later deferred spreads and cracks seem reasonably low compared to what we're seeing on the physical reality right now as you move into that driving season.
Agreed. Just to bring it back also, because you talked about, there's going to be a trade-off between products for April, but it's almost the same for May now. Ice gas oil is still trading almost $200 a ton higher than EBOB. So you have a very, very strong incentive, and ARB heating oil spreads are in a similar direction, right? So you have a very strong incentive to maximize distillate output in the Atlantic Basin, and not such an incentive at the moment to kind of bring those finished gasoline barrels to market, especially as gas nap is narrowing and those naphtha barrels are being pulled into either gasoline for the East or just directly into the East as well. So it's a potentially very acute situation, but the market maybe doesn't feel the need to price it just yet because there are more immediate issues that need to be dealt with in the next couple of weeks. And this is something that you can deal with or try to deal with in a couple of months instead.
Yeah. No, and the other news on gasoline was that there were reports or rumors, I would say, that the US is considering to switch the spec from RBOB to CBOB for summer. So moving from an F1 to an A2. What does that actually mean in terms of physical blend and potentially ARB movements and things like that? What do you think?
So the context is obviously we're kind of moving along this spectrum of the softest to the hardest kind of price suppression or domestic price suppression levers that the US administration will have, starting obviously with Jones Act, and then what we have seen so far is enabling at least adding a 20-day waiver for E15 to be still available nationwide into May. And the next thing, as you said, the next kind of rumor would be to move kind of nationwide to an A-grade spec rather than F1. In terms of what that means for ARBs and components, in terms of how you make that grade, it is, on simple terms, it's a less stringent or less difficult grade to make. So it is more maybe Eurograde plus naphtha if you're trying to blend it in Europe. And if you're blending it in the US, it's the ability to put a lot more naphtha and even a little bit of butane potentially at the margin into those finished barrels, which again at the margin maybe brings a little bit more supply into that domestic market. Maybe actually requires, therefore, less imports in the summer from Europe. But as we said, it's difficult to know at the moment because we don't have all of the details. But essentially, the idea would be that you will be allowing more naphtha into finished grade gasoline, and therefore, at the margin, bringing a little bit more supply into the US domestic market and relying a little bit less on imports into PAD 1.
Okay, so that maybe also explains a little bit the sell-off in gas naphtha. So it's maybe Primors, maybe the fact that you're going to be able to consume much more naphtha during summer.
Yeah.
Okay.
And I think I was just going to say the last thing on naphtha is that we are seeing now this price response from the downstream petrochemical pricing. So normally there's a lag, and we've seen that lag between oil flat price and these downstream petchem prices. But maybe we'll get Jorge on next week to talk a bit more in detail on that and share some of the actual numbers.
Yep. What can you tell us about diesel then?
Diesel's an interesting one. Again, it's seen also moves on the east-west to narrow, but because of some movements on the sales prices that we're seeing in Asia, we've actually seen the Houston to Singapore diesel ARB, which was a relatively new addition to the platform. It's not something that we've thought about historically, but that ARB is currently open. It's not open by a huge amount, but if you are loading still now in early April on an LR1 or an LR2, then it is essentially workable out of Houston into Singapore. It's workable out of Houston, presumably therefore also into Australia. It's a symptom of the fact that the market in Singapore, the market in Asia in general for distillates, has moved away from this very strong jet pricing that we saw and the high regrades to seemingly pricing more of a diesel shortage than a jet one. So the Sing regrade has turned negative. We have seen already kind of flight cancellations and demand destruction on the jet side. And so maybe that's kind of a little bit explaining why a regrade can be negative. We're moving out of heating season as well. So maybe there's a little bit of that for kind of the Northeast Asian market there. And otherwise, if we're looking at kind of this diesel versus kero story, we've also seen now Australia, for example, lowering its diesel specs through their winter now, but basically for the next 6 months, to an extent that will allow more kerosene into the diesel pool. If we're talking about, I suppose, the consumers that are going to notice shortages first, we've seen across Australia and parts of New Zealand that there are retail stations running dry. And when you get that happening, obviously there's a push from the government to respond. In this case, maybe it can allow 3-4 percentage points more of kerosene into their diesel pool, and it's just going to help allow those diesel to bring more diesel barrels into Australia potentially going forwards.
Yeah, diesel's the most sensitive product, right? It runs the economy, it runs construction, it runs the mining industry, it runs agriculture. Like you need to ensure that is in supply rather than kerosene, I would say.
Yeah. Just people have to either pay up or not fly, I suppose. Yeah.
Should we move on to? You want to talk about HOGO as well?
I mean, I suppose this is potentially right. It's an interesting one when we're talking about US kind of responses to higher retail prices. They seem to be largely focused on gasoline so far, and in reality, it's US diesel over 5 cents per gallon now, and that's going to be hurting, especially agriculture, the agricultural sector, as well as the trucking business in the US. Trucking is huge in the US, so this is going to be adding a lot of cost to US consumers. But so far, there hasn't really been a policy response to this, which means that HOGO is staying quite stubbornly high. And so maybe it's the European gas oil or European diesel market not yet needing to really not really needing to pull very strongly on Gulf Coast barrels, because it does still have strong incentives domestically to maximize diesel runs, to maximize runs overall. And it's got diesel SPR releases in Europe. And you can't have HOGO falling until you get PAD 1 stocks moving higher as well, which are still pretty low from what we've seen.
And Neil, on crude, can you tell us a bit more on the physical premiums outside of the whole political environment, but just on the actual market?
Yeah, I mean, and here I really want to just avoid talking about Murban and Oman premiums just now, because those are obviously absolutely wild. But for the purposes of gauging what's happening to the rest of the market, it's still a bit divergent. So I think we mentioned this last time. Clearly, the Brent-linked market is now skyrocketing. You have the kind of paper expression of that, the DFL, now at almost $8 per barrel. for April. So it's becoming very severe tightness in the North Sea. The WAF diffs have also reacted. I actually saw a bit more WAF now moving to Asia than normal for April load. So started to see a bit more of that. But the main issue in our tool is the fact that you've got this TI Brent paper issue, right? And it may be related to price suppression stories. And that is causing all American crude grades essentially to ARB anywhere they want in the world by a large margin. So we still have this problem in the North Sea where TI is exceedingly cheap. And that includes the freight, world scale, 500, 600, 700, depending on which month we're talking about, 40 to 25. That's not a problem for the TI ARB into Europe at the moment. And TI can ARB really, really well into Asia against Brent-linked stuff. And so I'm not surprised that, the news and the data of the last sort of 48 hours is suggesting Asia is going big time for WTI. You can see that in the fixtures. There's even talk of the Chinese thinking about upping the TI imports. So TI is the marginal barrel just now, and it's just not necessarily, kind of fundamentally justified. It is from a kind of logical perspective, but the TI Brent paper is what's actually driving this just now for the time being. And the problem, I think, still is this discussion that we keep having about deferred margins for Asia, right? So you have a very good prompt margin in Europe. You have very good margins in the US, obviously, right now. But many complex delivered margins for West-of-Suez crudes into Asia for, let's say, June delivery are not looking great. And it's related to everything that we keep talking about, like deferred cracks, freight to a certain degree. It's just a strange one. I mean, it seems like Asia's going well for WTI, and the TI margin is the one that looks okay in our tool. But for almost all of the crudes, it doesn't look good enough. And it's just this kind of conundrum that we keep on coming back to. So we'll see. And
well, isn't that because no one wants to price up the next 2-3 months? It's this idea. I'm already paying stratospheric kind of numbers. I don't want to put in a hedge or anything like that for. So I'm basically moving away from a 6 months program to just a month by month program and hoping that this reopens and we can go back to normal.
Yeah, I mean, it could be that, but it could also make sense. If you take a step back and just think about the big problem that we're talking about, you can't have Asia permanently having as much access to West-of-Suez crude as they want. Like, that's not how this is going to work, right? The Europeans and the Americans need their own crude. It's not like a free-for-all where we can just, triple flows to Asia permanently. So it does kind of make sense that Asia is struggling a bit to access West-of-Suez crude on the whole. And of course, it could be the European refiners that are bidding up Brent. Just now, they have the margin advantage, and so they have first dibs, and that is what we're talking about, right? The actual solver is run cuts, and you don't have reports of massive run cuts, and you have mega good ARBs and mega good flows of crude to the east at the same time. Those are two stories that don't fit together, fundamentally speaking.
Yeah.
So we'll see. And the other thing just to talk about is the premiums for the kind of US LATAM sours. They're actually not doing that well. Like, they peaked several days ago. They keep on coming off. I just wanted to point out, I think I've done it before in our written commentary, but the US and that kind of nexus over in the Western Atlantic, that's, relatively speaking, the longest place for crude, so to speak, right? So they've got 1 million barrels per day of SPR release. They've got natural supply growth coming out there. They've got access to Venezuelan, and a lot of it's sour as well. So the US will be upping diesel yields, for example. They can afford to run hard. And generally speaking, it's like the softest physical market, relatively speaking, in the world at the moment. And that's what's showing up in some of the premiums as well.
Yeah, but why would they come off? One thing is being cheaper. Another thing is getting lower on a daily basis.
Yeah, I don't know exactly. But it does make sense directionally from like who's really long crude at the moment relative to where they were. Just added 1 million barrels per day of SPR release, which is actually quite a lot for the sour Gulf Coast market.
Is that based on the freight, maybe? That you don't have that freight availability, and therefore you cannot continuously push cash premiums up, as at the end of the day, you don't really have that many vessels that can load? Or, I'm just thinking out loud here, but I'm just surprised with why, in an environment where everyone is, you said it before, Asia and Europe will be bidding up for cargoes. Let's just say that they're all equal, which they're not, of course. No, but I mean, Then the bottleneck then perhaps is that you want to load, but you don't have a vessel. Therefore, at some point, the cash dips come off because there's just lack of bids.
Could be.
We may also be getting back into we may also be getting back into territory of just hesitancy amongst those refiners who are looking to replace their kind of Middle East sour base slate. Hesitancy, not just on a pricing perspective, but also on a quality perspective, right? These are grades that they maybe have never actually run before. And so there's a risk in suddenly wholesale take out what you've always run and try and run it on something which maybe on paper has a similar API, even a similar sulfur. But when you're actually trying to run that in your refinery, you're going to find there are other constraints, metals, whatever it is, that mean that actually you're going to risk damaging your refinery. And so there's not just a price hurdle, but also a quality constraint hurdle for getting those barrels where they're needed in the East.
It's true of Europeans as well, right? They're not going to run a bunch of Mexican barrels easily, let's say, at the moment. But it does get solved by price eventually, and it's something that we talk about internally all the time. Is a $10 per barrel discount not enough to get over some of these hurdles? You would think it would be in a normal market, but apparently not at the moment.
Okay. Well, I think that's it for today, guys. Thanks a lot. And thanks for the listeners to be there every week. And we see you guys next week.
Cheers.